Please take it away, Greg.
Thanks, Brian. As Brian mentioned, my name is Greg Smith. I'm the president and CEO of the company. And thanks everyone for attending this presentation today. Before I jump in, I will be making some forward-looking statements over the course of this presentation, and this disclosure is available on our website and on the conference website. So Equinox Gold is still a relatively young company. In fact, 4 years ago to today, we announced the acquisition of the Mesquite mine in California. Mesquite was our first producing mine. And since that time, we've grown to have 6 producing mines across the United States, Mexico, and Brazil. We also have our new Santa Luz mine, which we're commissioning now, which will be our 7th mine. And we're about a year into construction on our Greenstone gold mine joint venture project in Ontario. Across these mines, we have 16 million ounces in reserves, and we have 30 million ounces in resources inclusive of those reserves. From zero production 4 years ago, we've now grown to have approximately 580,000 ounces of gold production for this year. And we're on a path to increase our production to over 1 million ounces of gold per year from our existing portfolio and expansion plans. We're traded on the TSX and also the NYSE American, and our current market cap is around US $1 billion. So moving on to our assets, I'm going to start with our Greenstone gold mine joint venture project in Ontario. This mine is a joint venture between Equinox and Orion. We acquired our interest back in 2021 when we acquired Premier Gold Mines. We then increased our interest from 50% to 60% subsequent to that transaction. Orion Mine Finance has the other. We strongly believe that the Greenstone Gold Mine is one of the most attractive development assets in Canada. Once built, it'll be our largest mine in the portfolio. The deposit at Greenstone is one of the highest grade open pit deposits of scale in Canada. The mine has a 5.5 million ounce reserve, and it's got another 4.5 million ounces in resources, which would be part of an underground expansion eventually in this mine life. Greenstone benefits from excellent infrastructure. It's about 3-hour drive from Thunder Bay along the Trans-Canada Highway. It's in an area with a resident workforce. There is power to the site. We're within a few kilometers of the Trans-Canada natural gas pipeline. And we've got fantastic community support at Greenstone, both from Geraldton and also from the broader municipality of Greenstone and from the First Nations communities that are in the area of influence of the project. Once operating, Greenstone will process 27,000 tons of ore per day, produce 360,000 ounces of gold per year on average for 14 years. And in the first 5 years, will produce over 400,000 ounces of gold per year. We closed the acquisition of Greenstone in April last year, and we announced construction in late October last year. So we're almost a year in. And over that period, sort of pre-announcement of construction, we actually conducted a fair bit of work. This included spending $50 million on pre-construction readiness that included tree clearing, surface prep, camp construction, water treatment plant construction, ordering of long lead items, making deposits, advancing engineering, geotech drilling, etc. This activity led us into the fall, at which point we worked to update our budget, update our schedule. At that point, we were 85% complete on detailed engineering. We did a comprehensive review of costs. We increased the budget. We increased the schedule. We had a third party conduct some reviews on that work, and then announced construction in October of last year. So as a result of that, we did increase our budget from the feasibility, which was about $950 million, to $1.23 billion. We also adjusted our schedule to make sure we had enough float in the schedule to account for any supply chain disruptions that might occur over the course of the build. We looked at things like inflation. We increased our contingency. We accounted for the detailed engineering that had been complete to that date. And we also excluded certain things like pre-production gold revenue or opportunities around leasing mobile equipment, et cetera. Since that time, the budget will have some incoming revenue from gold pre-commercial production, probably around $70 million. We have completed a lease on certain mobile equipment, which will defer about $53 million from that 1.23. And we've also looked at some other minor infrastructure around the community that probably will be deferred post-construction. That's around another $15 million. So in short, we were very prepared and advanced when we started construction. And then when we hit a 100% detailed engineering back earlier this summer, we conducted another QRA assessment, a quantitative risk assessment, looked at the whole schedule again, updated the budget again, and had a third party review that information. About a week and a half ago, we had analysts, shareholders, some other stakeholders come to the mine site, process plant area here. It was a great visit, and I think everyone was impressed with the progress we've made. I'm very happy to report that right now the mine or the construction project is on budget and it's on schedule for first gold pour in the first half of 2024. Moving south to Brazil to our new Santa Luz mine. The Santa Luz mine is one we constructed most of last year. We had first gold pour in March of this year. And since that time, we have been in commissioning toward commercial production. Right now, the mine or the mill, is operating at full capacity. The resin leach circuit is also performing very well. And we're now achieving about 75% consistent recoveries. Our target is 84. We're working to get there. But I think by the end of this month, we're going to go ahead and announce commercial production at Santa Luz. We expect this year to do about 45 to 50,000 ounces of gold production, and then Santa Luz going forward should average around 100,000 ounces of gold production per year. In addition to Greenstone and Santa Luz, we have 6 operating mines in the portfolio. Our US business includes our Mesquite mine, which was our first producing mine, as I mentioned earlier, and also our Castle Mountain deposit in Southern California. Castle Mountain is currently operating under our phase 1 scenario, which is a fairly small open pit heap leach operation. But Castle Mountain also represents one of our key expansion opportunities within the portfolio, and one we're very focused on, which would take production at Castle Mountain from its current 25 to 35,000 ounces of gold per year up to over 200,000 ounces of gold per year over a very long mine life of 15 years or so. So in March, we did submit the permit applications. We're working through that permitting process now for the expansion. And ideally, we would have that permit sometime as we're bringing Greenstone into commercial operations, such that we can then start focusing on the expansion at Castle Mountain. In Mexico, we have our Los Filos mine. This is also a very large project for us in Guerrero. Right now, it's operating as an open pit and underground combination, feeding a heap leach facility. We are working on a technical report, which would demonstrate an expansion of Los Filos to over 300,000 ounces of gold production per year, with the construction of a 10,000 ton per day carbon and leach circuit. For those that follow the company, you'll be aware that we have had some social challenges at Los Filos. So we are working at the community level with the state government to ensure we've got a very stable base for operations, a stable environment for operations before we would actually embark on that expansion. As I move south down to Brazil, we have our Brazilian business, which right now has 3 mines, the Aurizona mine, the Fazenda mine, and the RDM mine. Santa Luz will be our 4th Brazilian mine once it reaches commercial production here very shortly. Including Santa Luz, our Brazilian business today would do around 300,000 ounces of gold per year. We do have an expansion plan at the Aurizona mine based on a pre-feasibility study for the addition of an underground mine that we published last year. We're now working on the feasibility study for that expansion, and expanding or adding an underground mine to Aurizona is something we will be focused on over the next few years. So this slide kind of highlights why I think Equinox is very good value right now. I think I mentioned earlier we're about a $1 billion US market cap, but we've got one of the highest growth profiles of our peer group. 580,000 ounces this year, but there's 600,000 more incremental ounces that will come as we execute on these expansion plans. On a price to net asset value against intermediate gold producers, we're at the very bottom end of that valuation. Our multiple here is 0.45. The average for intermediate producers is 0.65. Senior producers 0.85. All very low given the market, but still we're the lowest of the low. I think and hope and expect that as we bring Santa Luz into commercial production, as we advance Greenstone and bring that into production and convert, some of our NAV that's currently development into operating, I think we should move up this sort of value curve, have an increase in our multiple, and see that increase reflected in our share price. We've got a very strong balance sheet at Equinox. We're sitting on, depending on the day, about $150 to $200 million in cash. We have $220 million available under our revolving credit facility, and we have another $100 million accordion feature associated with that facility. We've got cash flow from our operating mines, and we also have a equity portfolio worth about $250 million. So very good funding situation for the company. As I mentioned, Equinox is still a young company. We're a growing company. Our ESG reporting is growing with us. So this was only the second year that we published our annual ESG report. We did that back in the first quarter. Every quarter, we also publish our safety, environmental, and GHG emission data when we file our financial statements. But more importantly, we're continually looking at ways where we can improve. And that could include moving to filtered or dry stack tailings, water conservation initiatives, carbon credit offsets, green fuel, green energy, things like that at our operating base. We're also working to set a near-term greenhouse gas emission reduction target and eventually want to get to the point where we can set a target for net zero. Equinox is managed by an experienced management team, an experienced board of directors led by our chairman, Ross Beatty. Our board, our management team are very aligned with shareholders. Ross is our single largest individual shareholder with about 8% of the company. All of the senior management team carry fairly large positions in the company for our individual circumstances. Most employees, certainly in Vancouver, are part of a share purchase program. So we're all owners of the company. We're all aligned with shareholders. And of our peer group, we've got the highest level of insider ownership, second only to Endeavour Mining. So we've been working hard over the last 4 or 5 years to create the premier America's gold producer. And today, we've got a diversified portfolio of assets, roughly allocated equally between Canada, the United States, Mexico, and Brazil. In the near term, as I said, we're focused on bringing Santa Luz into commercial operations. We're working on that technical report, and we should release that in the next 2 months or so on the Los Filos expansion. And we're working very hard to bring the Greenstone gold mine joint venture into production on time and on budget. Looking forward, in a few years, we're going to have a very strong operating portfolio between our large-scale mines in Canada with Greenstone, Castle Mountain in the United States, and Los Filos in Mexico, and then our Brazilian business made up of the Aurizona mine, Santa Luz Fazenda, and RDM. And I think with that, I'll wrap up. Again, great growth profile at Equinox, lots going on today, and in a few years from now, we're going to have one of the 5 largest open pit gold mines in Canada operating in our portfolio. And with that, I'll conclude, and I think I've got some time for questions.
With questions, if anybody has a question, please raise their hand so a microphone can be brought over. I think we've got a fairly quiet group this afternoon. Maybe the first question I can kick off with is there a right size for the company?
So we've always had a target of 1 million ounces of gold production per year, and I would say there's nothing special about that number. We're careful to make sure that's not really the target. The target is achieving a certain level of scale, I would say sustainability, optionality, where the company can maintain their production, continue to grow, be a larger scale, highly profitable gold company in Canada. And that's been a it was an ambitious target a few years ago, but we're actually starting to make our way toward that goal. Beyond that, Brian, I'm not sure. I mean, I think we're always commercial. So if there's good opportunities that we think are accretive to our shareholders, we're always willing to look. But right now, we've got a very clear plan to kind of get to that level, and that's what we're focused on.
And given that almost every one of your assets has some form of growth potential, would there be any thought of divestment as you go through the process?
Well, over the last few years, we've divested a fair number of assets. We spun out our copper company into Solaris Resources. We sold the Pilar mine to Pilar Gold. We sold Mercedes to Bear Creek Mining. We recently created a royalty spinoff in cooperation with Sandstorm. So we have been kind of doing that as we go. There are certain assets in our portfolio that certainly we consider divesting if the right offer or right opportunity presented itself. And you can see where we're focused, right? Greenstone, Castle Mountain, and the expansion projects.
So maybe just digging into Greenstone a little bit, it's somewhat unusual that you have such a large financial partner there. How is that arrangement going, and how would you compare and contrast that with other joint ventures you may have been involved in the past?
Well, when we acquired our interest in Greenstone, and then we actually bought another 10% from our joint venture partner Orion, just so we could increase the position and kind of take that majority owner role. I mean, frankly, we did kind of think long and hard about whether we wanted more at that time and whether that would make sense. And I think from our perspective, the capital is a big nut to crack for a company of Equinox's size. Orion is very well funded. They've been a fantastic joint venture partner. The joint venture is managed by a board of directors that has people from Equinox and Orion sitting on that board, and then the Greenstone team reports up to that board. And so everything we've done has been in cooperation and with the involvement of Orion. Longer term, of course, we'd love to own more of the assets. So that's something that in the future we'll certainly want to talk to them about. But as far as the joint venture's been going and the administration of it, it's been great. They've been great partners.
And as much as you're active in the Americas, those are four relatively different from each other jurisdictions to work in. Your Brazilian assets, where you have more assets and perhaps less growth. How are you finding, working in Brazil? In terms of how COVID has been. We hear different stories from different people. Maybe you can just give us a little bit more of your experience in Brazil in particular.
I think Brazil's been very good to us, and I've worked there in the past and have had some challenges in the past, but overall, I would say our experience in Brazil has been very positive. The foreign exchange rates cooperating there, you can get very skilled labor. We've been able to get the permits most of the time when we need them, grow our business there. So from that perspective, it's been great. COVID across the company obviously was a big challenge initially, and it took some time to get the right policies and procedures in place. And just like everyone, we had a lot of employee periods of time, but the guys there did a great job of navigating through it. And so, frankly, we've gone past it now, and it doesn't feel like it was all that bad, really. I think we've been happy in Brazil.
And I know you did a very recent update on your feasibility study at Greenstone, and you're on time and on budget, as you mentioned. Have there been a softening of the pace of inflation in your eyes so far, or has it just been continuing to work on the schedule that you've got? So
earlier this summer, we recast the budget, the forecast of what we have left to spend, allocated some of our contingency to various buckets. A lot of that was based on where we saw the trend at the time. And since that time, we have seen those trends come the other way and start to soften. It may be an opportunity for us to recover some of that contingency back, from those buckets back into contingency. I'm hesitant to say that we've seen this, real meaningful decrease, but I think the pace of inflation, at least in our input costs and labor and some of those other things, has slowed down definitely. And in some cases, it's come off from where we were benchmarking just a few months ago.
And just one last, yeah, please.
Sorry, Anita Soni, CIBC. Greg, can you just address the costs this year and the inflationary pressures that you've seen, and how you expect that to evolve going into 2023? Or should we expect costs that are at similar levels, or you've got RDM running fully next year, hopefully, so that won't be as bad. But can you just address a few of the main drivers?
Well, I think like everyone, we were hit with inflation, and we definitely felt it in fuel prices, particularly at Mesquite, and we've seen it in cyanide and ammonia and a whole bunch of different input costs. Less quickly in labor, but absolutely where we've had to, the regular operating costs of the mines. The costs this year are a little elevated for different reasons at the various assets. I think certainly globally across the company, we would expect them to come down next year, not necessarily because inflation's coming down, but because we're going to be running through some of the all-in sustaining costs that are hitting some of the sustaining capital is hitting our all-in sustaining costs this year. Plus, we'll have Santa Luz running for the full year, and I think we'll be in the higher grade of Los Filos and see some other increases in production that on a per unit basis should see costs come down. But it is challenging when you've got sort of that inflation against a stagnant to decreasing gold price. We've seen margins contract just like everybody.
And if there's no further questions, please join me in thanking Greg.
Thanks, Brian. Thank you.